Chapter 4 discusses the way a company's accounting system tracks all the transactions that occur every day in a company. Such transactions culminate in publicly available information in the form of financial statements. It is important for you to understand the steps involved in this process. Now, this process, referred to as the accounting cycle, begins with analysis of transactions and ends with preparation of financial statements and closing of temporary accounts. When you follow these steps of the accounting cycle, every transaction flows to the financial statements, enabling investors, creditors, and other users to understand the financial position and economic performance of the organization. The learning objectives are: describe the accounting cycle, explain transaction analysis, including the use of the accounting equation, illustrate journalizing transactions, including determining whether to debit or credit accounts, explain the importance of and show how to post transactions to the general ledger, explain the importance of and illustrate the preparation of an unadjusted trial balance. 6. Discuss the need for adjusting journal entries and explain deferrals and accruals. Explain the use of and illustrate the preparation of an adjusted trial balance. Describe the preparation of the financial statements from the adjusted trial balance. 9. Explain the difference between permanent and temporary accounts and demonstrate the process of closing temporary accounts. And 10. Explain the importance of and illustrate the preparation of a post-closing trial balance. So the first objective is describe the accounting cycle. A company's system tracks all the transactions that occur every day and ultimately aggregates and summarizes them in publicly available financial statements. The accounting cycle describes the process by which a company records transactions in its books and summarizes their effects in the financial statements. In Chapter 4, we will discuss the steps in the accounting cycle. In both the US GAAP and IFRS, the accounting cycle begins with analyzing transactions and ends with preparing a post-closing trial balance. As a roadmap for Chapter 4, here you'll see in Exhibit 4.1, it presents the accounting cycle. Notice there are 9 steps that they have listed here. But I believe there is one step that should be there. Can you guess which step is missing? I believe step 1 should be obtain information about external transactions from source documents. So I wonder why the book did not include the most important step, which is you have to have the source document. You have to know what is the source document in order for you to analyze the transaction. I believe that steps 1 through 4 takes place during the accounting period, while steps 5 through 8 occur at the end of the accounting period. Steps 9 and 10 are required only at the end of the year. My assumption is that the book did not include the first step, which is obtaining information or having the source document, is because this is Intermediate Accounting 250, and your first accounting course should have included that information. Therefore, you should know that in any transaction, you have to know the source document. You have to have the source document. So again, like I said, you have to have the source document. The first step in the process is to identify external transactions affecting the accounting equation. An accountant usually does not directly witness the business transaction, but they know that they have to have the transaction. They have to have that information. So a mechanism that is needed to relay the essential information about each transaction to the accountant is the source document. Now, source documents such as sales invoices, bills from suppliers, cash register tapes, purchase invoice, shipping documents, all these serve this need. So what are the first and the last steps of the accounting cycle? What are the first and last steps of the accounting cycle? The first step is to identify external transactions affecting the accounting equation. The last step is prepare a post-closing trial balance. Learning objective 2. Explain transaction analysis, including the use of the accounting equation. Once you've identified the external transaction affecting the accounting equation, an accountant will analyze the transaction. The accounting equation demonstrates that creditors and owners have claims to a company's assets. In analyzing the transaction, you're reviewing the source document to determine the dual effect on the accounting equation and the specific elements involved. So what is a transaction? A transaction is no more than an economic event that involves a change in an asset, a liability, or a stockholder's equity account that companies record in their accounting records. The accounting equation illustrates the relationship among assets, liabilities, and stockholders' equities as follows. Assets equal liabilities plus stockholders' equity. Here you see in Exhibit 4.2, it defines the main elements that appear in the accounting equation. Also, in this exhibit, it presents the U.S. GAAP definitions from FASB concept statement number 6, which is the elements of financial statements. Assets are probable future economic benefits obtained or controlled by a particular entity as a result of past transactions or events. Examples are cash, receivables, inventories, buildings. Liabilities, probable future sacrifices of economic benefits arising from present obligations of a particular entity to transfer assets or provide services to other entities in the future as a result of past transactions or events. Some examples are accounts payables, salary payable, note payable, and bonds payable. Stockholders' equity, the third element. It is the net assets or residual interest in the assets of an entity that remains after deducting its liabilities. Contributed capital consists primarily of owners' investments in the business. Accumulated other comprehensive income increases or decreases with other comprehensive income. Other comprehensive income is an additional component of comprehensive income. Now, when revenues and gains exceed expenses, losses, and dividends over time, retained earnings is positive. Now, retained earnings is negative when expenses, losses, and dividends exceed revenues and gains over time. A negative balance in retained earnings is called a deficit. So the fact that all transactions affect at least two accounts and that the accounting equation will always balance is referred to as the double entry system. For example, if an asset increases, then there must be either a decrease in another asset, an increase in liabilities, or an increase in stockholders' equity. An expanded version of the accounting equation includes the components of stockholders' equity, contributed capital, retained earnings, and accumulated other comprehensive income. And we all know that a negative balance in retained earnings is called a deficit. Here, Exhibit 4.3, it reviews the definitions of the elements that appear in the expanded accounting equation. Exhibit 4.3 also shows the U.S. GAAP definitions from FASB concept statement number 6, elements of financial statements. Now, the IFRS definitions, they're somewhat different. And we explain that in Chapter 2. But these differences do not affect the explanations of the steps in the accounting cycle. Here you see the elements: distribution to owners, revenues, gains, expenses, and losses. Distribution to owners: decreases in equity of a particular business enterprise resulting from transferring assets, rendering services, or incurring liabilities by the enterprise to owners. Distributions to owners decrease ownership interest or equity in an enterprise. Dividends are common distributions to owners. Revenues. Revenues are just basically inflows or other enhancements, excuse me, of an entity's assets or settlements of its liabilities from delivering or producing goods, rendering services, or other activities that constitute the entity's ongoing major or central operations. Gains, they're increases in equity from an entity's peripheral or incidental transactions and from all other transactions and other events and circumstances affecting the entity, except those that result from revenues or investments by owners. Expenses are outflows or other consumption of assets or incurrences of liabilities from delivering or producing goods, rendering services, or carrying out other activities that constitute the entity's ongoing major or central operations. And of course, losses are decreases. They're decreases in equity from an entity's peripheral or incidental transactions and from all other transactions and other events and circumstances affecting the entity, except those that result from expenses or distributions to owners. Here you see in Exhibit 4.4, it presents the components of stockholders' equity graphically. Now, stockholders' equity is comprised of contributed capital, retained earnings, and accumulated other comprehensive income. Also, ending retained earnings is equal to beginning retained earnings and is increased by net income and decreased by net losses and dividends. Net income or a net loss is increased by revenues and gains and decreased by expenses and losses. An expanded version of the basic accounting equation includes the various components of stockholders' equity. Stockholders' equity in equation form is stockholders' equity equal contributed capital plus ending retained earnings plus accumulated other comprehensive income. Revenues and gains increase retained earnings, whereas expenses, losses, and distributions to owners, which are dividends, decrease retained earnings. Now we represent retained earnings in equation form as you see here. Ending retained earnings equal beginning retained earnings plus revenues plus gains minus expenses minus losses minus dividends declared. Now, given that equation 4.2 and 4.3 that we saw earlier, we expand the basic accounting equation to represent the elements of stockholders' equity as shown on this slide. Now, this expanded equation allows companies to analyze complex transactions. The accounting equation implies that each economic event affecting this equation will have a dual effect because resources always must equal claims. Take a look at the events that you see here. These are events that occur in transaction. Number one, an attorney invested $50,000 to open a law office. So an investment by the owner, excuse me, an investment by the owner causes both assets and owner's equity to increase. So there's an asset of $50,000 and owner's equity, $50,000. So you see that both sides of the equation, the accounting equation, must equal. Number two, $40,000 was borrowed from a bank and a note payable was signed. Now this transaction causes assets and liabilities to increase. A bank loan increases cash, but it creates an obligation to repay it. So there's a $40,000 in liability. Number three, supply costing $3,000 for purchase on account. Buying supplies on credit also increases both assets and liabilities. What is the basic accounting equation? What is the basic accounting equation? And the answer is assets equal liabilities plus stockholders' equity. Assets equal liabilities plus equity. Now we will go into objective number three, which is illustrate journalizing transactions, including determining whether to debit or credit accounts. Now, after you analyze the transaction, the next step in the accounting cycle is to journalize the transaction by formally recording the transaction in the accounting system. I will explain the journalization process, including the specific accounts, debits and credits, and journal entries. A company records each transaction in specific accounts. What is an account? An account is an individual record of increases and decreases in specific assets, liability, and stockholders' equity items. Here you see in Exhibit 4.5, it provides examples of assets, liability, and stockholders' equity accounts. Assets are considered cash, accounts receivable, inventory, prepaid rent, building, equipment. Some examples of liabilities are accounts payable, wages payable, notes payable, bonds payable, equity, common stock, retained earnings, sales revenue, cost of goods sold, salary expense, gain on sale of equipment, loss on sale of investments. Those are just a few examples. A company's accounting system assigns each account a unique account number shown in the chart of accounts, which is a numerical listing of the account names and numbers that assist in locating the account in the ledger. The accounts are typically numbered in balance sheet order. You have your assets, liabilities, equity, and the component of stockholders' equity, including dividends, revenues, gains, expenses, and losses. Here you see in Exhibit 4.6, it gives us an illustration of a sample chart of accounts. Assets begins with 1, liabilities 2, stockholders' equity begins with 3, revenues are always 4, and expenses are beginning with the number 5. Here's another example of the chart of accounts. Assets, the economic resources you possess, liabilities, what you owe. Equity, what you or others have invested. Revenue, income earned from sales of goods or services. Cost of sales, expenditures directly related to the production of goods and services. And of course, you have your operating expenses. Just as assets equal liabilities plus stockholders' equity, debits always equal credits. Debits always equal credits. Now, this simple fact that debits equals credits forms the foundation of the double entry system of accounting. All transactions will result in debits equal to credits. Note that each account shows the balance that we call a normal balance. And the normal balance refers to the expected balance in an account, and it is the side that increases the value of the account. So with the normal balance, the balance is the debit or credit side used to increase the account. Here in Exhibit 4.7, it presents the conventions for debits and credits in terms of increasing and decreasing accounts. Now, asset accounts, such as cash and inventory, increase with a debit and decreases with a credit. So when a company makes a sale of $400 and collects cash, it will debit cash by $400. Now, when a company pays employees, cash decreases, so it credits the cash account. In general, liabilities and stockholders' equity increase with a credit and decrease with a debit. When a company purchases inventory on account, it credits accounts payable to reflect an increase in a liability. When a company pays its supplier the amount owed, it debits accounts payable to reflect a reduction in the liability. Equity accounts, such as common stock and retained earnings, also increase with credits and decrease with debits. Revenues and gains are increases in equity, so these accounts will increase with credits. However, expenses and losses decrease equity, so they will increase with a debit. Similarly, dividends decrease equity, so dividends also increase with debits. Journalizing a transaction is the process of entering a transaction in the general journal. To journalize a transaction, companies prepare a journal entry. A journal provides a chronological record of all economic events affecting a firm. Each journal entry is expressed in terms of equal debits and credits to accounts affected by the transaction being recorded. Debits and credits represent increases or decreases to specific accounts depending on the type of account. So a journal entry contains the date the transaction occurred, the accounts debited are listed first and positioned at the left side, accounts credited are recorded next and indented to the right in a few spaces, and it also provides a brief explanation for the journal. You should always provide a brief explanation. And we'll see this here. Example here, Plush Service Corporation issued 10,000 shares of its common stock for $80,000 on January 2nd, 2008. You see here that the date of the transaction is January 1st, which is the first column. The amount debited is listed first and positioned at the left side. The dollar amount debited is $80,000 and is placed in the debit column. The amount credited, which is common stock, is indented to the right a few spaces over. So you see the dollar amount is credited for $80,000 and it is placed in the credit column. And below you see there's a brief explanation as the reason for the journal entry. And it is to record issuance of common stock. Because events are recorded in the general journal first, it is known as the book of original entry. Using the general journal as a first record of an economic event has several advantages. The general journal maintains a complete record of the transaction and provides an explanation of the event when the transaction involves complex events. In addition, all economic events are listed in chronological order, facilitating the location and correction of errors. What term refers to the expected balance in an account that increases the value of the account? We're here at the end of Objective 3. And the question is, what term refers to the expected balance in an account that increases the value of the account? And the answer is normal balance, the normal balance. We're going into objective number 4, which is explain the importance of and show how to post journal entries to the general ledger. Now, each account balance is maintained in a single location for management analysis. An account has a debit balance if debit exceed credits, and a credit balance when credits are greater than debits. An account has a zero balance if debits equal credits. Each general ledger account has columns for the date, explanation, reference, debits, credits, and balance. The reference is the general journal page number. Posting involves transferring debits and credits recorded in individual journal entries to the specific accounts affected. Of course, we know that most accounting systems today are computerized. Now, for these computerized systems, the journal input information creates a stored journal and simultaneously posts each entry to the ledger accounts. Here you see in Exhibit 4.8, it illustrates Plush Service Corporation's posting of the journal entry to the general ledger for the common stock issued on January 2nd, 2018. You see here the balance in the cash account, number 100, increases by $80,000 to $118,000. And the reason for that is because it already had a balance of $38,000. So 8,000 plus 38 is 118. The balance in the common stock account, number 300, also increases by $80,000 to $140,000. And it increased because the balance in the common stock was at 60,000, so 60 plus 80 is 140. The reference column in the General Ledger indicates that the entry is from page J1 of the General Journal. Here in Exhibit 4.9, it presents a sample T account. Now, T accounts will be used for many examples rather than formal general ledger accounts. And some accountants today, they still use T accounts before they actually post a journal entry into a computerized system. And here we are at the end of objective number 4. What are the 3 main parts of a T account? What are the 3 main parts of a T account? The accounting title. We have the left side, which is the debit, and the right side, which is a credit. Okay, we're here for a group exercise. I am going to divide you into the 2 groups, and you're going to complete journal entries for the transactions that you see here.